Welcome to TC Daily, the technology show brought to you by Tech Central. If you're new to these parts, do subscribe to us on YouTube at youtube.com/Tech Central. And if you haven't subscribed yet to Tech Central's newsletter, you can do so at techcentral.co.za/newsletter. Now, I've got two great guests in the studio today, both from Alviva. Is it Alviva or Alviva? Alviva. I'll try and remember that, Pierre. Pierre Spies is Group Chief Executive of Alviva Holdings. And we also have with him Craig Brusden, who's CEO of, I think, Alviva's biggest subsidiary. Is that right? Axiz?
By revenue? It is
biggest by revenue. Okay.
By revenue and profit after tax.
Okay. Right. Well, welcome, guys. It's good to have you both in the studio. I'm really keen to find out what's happening at Alviva. There's been a lot of news just lately, including your results last week, which were rather stunning, actually. You boosted your dividend by 90%. Your revenue was up 57% to 23 odd billion rand, obviously helped by the acquisition of Tarsus Technology Group. But even without that, your revenue would have been up 23%. Axiz, 40% improvement in profit after tax. I believe Pinnacle and all the other businesses also performed exceptionally well during this period. Pierre, did you guys not get the memo that the South African economy is in the toilet?
We're blessed. We're very fortunate what we have, I must say. It's a strategy in the making. We embarked on about 6 years ago to be a well-diversified ICT group, and it's panned out well for us. So we just stuck to our guns. We didn't waver from our strategy through COVID. Yeah, through 2 tough years, still profitable, but tougher years. Mm-hmm. And then it just, all the planets aligned for us.
Right. So tell us about this magical strategy, because there's a global semiconductor shortage. As I said, the South African economy is not exactly performing particularly well at the moment. How have you guys actually managed to do this?
It's called peer pressure.
What's the secret? What's the secret recipe?
It's called peer pressure. No. It's just a specific KPI in each business. And we rent this. It's a very corporatized business.
Yeah.
Ethics is number one. Wherever we go, ethics is number one. We don't budge at all. Mm-hmm. So we drive that very hard through it. And culture, changing the culture. Single biggest thing we've had to in the last 6 years, again, the culture's aligned and all the businesses aligned from a corporate governance perspective.
Yeah.
So that's panned out very nicely for us, and proof's in the pudding. So from being the underdogs to being one of the market leaders. So we're very pleased with the results.
Okay.
And proud of the team. We've got a phenomenal team.
Yeah. So Craig, maybe expand on that a little bit. And I mean, obviously, if your revenue is growing at these sort of levels, organic 23%, 57% if you include Tarsus, and Axiz also performing phenomenally well during this period. That means consumers are buying. People are buying your products. There's demand out there. Where's that demand coming from?
Well, I think the story last year was really about the consumer demand. So the PC market bounced back really strong after the 2020 shutdowns and the disruption. So to be fair, we're coming off, the whole industry is coming off a low base, but the resurgence in the consumer demand was something that caught us all off guard. I mean, worldwide shortages, as you said, some of that was created by lockdowns, but a lot of that was actually created by the demand. Mm-hmm. So I think we all benefited from that. The other thing I think Alviva, as the group, has got going for it is while we're a conglomerate, federated group of businesses, diversified, we've got a great spread of technology brands. So no single company's stuck in one channel, if you like. Mm-hmm. We've all got exposure to most of the markets. So, we don't have a single event that can disrupt the group too much. Mm-hmm. And I think almost all the subsidiaries were well positioned in the PC or the consumer demand comeback. And that was corporate decisions as well. So, and that's cooled off a little bit in the second half of the year, of our fiscal year, which was to June. But we're seeing that replaced with other demand. So.
Right. So where's the demand coming from going forward?
I think right now, and you would maybe see those shortages have moved out the PC or consumer edge device markets into the corporate technology. So networking, storage, servers are really under pressure at the moment.
Is this because everyone's back in the office?
Yes, I think there's a number of theories and there's a number of reasons for the actual short supply. But it's amazing. The last few years, we've had this demand, then short supply. Then the supply recovers, the demand moves to another sector. The shortage continues, and so right now, networking by far is under the most strain. That would talk to a return to office demand pattern, and edge computing devices have cooled off considerably. So, it's a very challenging, turbulent time to be navigating at the moment.
Let's talk a bit about the semiconductor crisis that we saw over the last what is it, 18 to 24 months.
Yeah.
It seemed to be affecting high-end chips mainly, and also automobile supplies were affected. What's the situation right now? Are you seeing semiconductors flowing freely again? Are you seeing shortages in some areas? Are you seeing oversupply in other areas?
I'd say yes to all of the above. Massive oversupply. So feast of famine. That's what it was. A feast of famine. So initially you couldn't get stock for love of money.
Yeah.
18 months, 2 years, like you said. And then November, December last year, there was a big shift in the market where there was oversupply in Europe, and all of a sudden they slowed down, or the retail market specifically slowed down. That moved to South Africa, and we received hundreds and hundreds loads of container loads worth of stock overnight. So from having no stock to having oversupply of stock.
So what stock are we talking about here?
What's retail stock? Mainly retail.
There'll be laptops.
Laptops, mainly laptops. Yeah.
Okay.
Devices.
And that was the biggest demand. For 18 months COVID, biggest demand work from home was laptops, like Logitech, your peripherals and that, and then monitors. But then from not having any stock to having complete oversupply of stock from every single vendor. Not one vendor, every vendor ship simultaneously. So it puts pressure on your stock files. And with the stock files balloon over 3 billion, and then you have to manage that. So, and then from there, still overstocked on retail, but retail as such has slowed down due to multiple factors, mainly the increase in the interest rate and also the recession in the market.
Yeah.
So it's a timing thing for us. We're not too concerned. It's a timing thing. But there are shortages in high-end notebooks.
Still.
But not to the extent of a year ago. There's still shortages.
Right. I mean, you've certainly sorting graphics cards. The price of graphics cards got ridiculous a year ago. Yeah. And then suddenly the situation changed and the prices tumbled 60, 70, 80%.
Yeah. And you can even see it in the stock valuation, the stock prices of companies like NVIDIA.
Yes.
They went absolutely nuts and have retreated significantly since then. So it's very challenging to try and pick it. But the shortages are now in data center. So equipment, anything really going into the data
Racks,
center. Servers, storage, networking in particular, like I mentioned.
Why is that? Is that because the big hyperscalers are buying it all up? Or?
No, I think the demand, the production, that's a supply problem. The production has moved from, semiconductors. The shortage is not so much just chips, it's semiconductors generally. So anything on the motherboard, silicon. That's why the automotive industry, all industries that use anything related to computing, keyboards, or electronics have been affected. It's just as the supply demand is balanced in each industry, we've seen it move in different pockets. So everybody rushed to make laptops. That capacity wasn't quick enough to make routers, and now we've got the imbalance there. And then you've got the demand surge for routers, demand tanks for laptops. Now we have the opposite problem.
Is the industry just bad at managing demand? What causes this?
That's $1 million question. There isn't a single vendor we work with that I know that could explain that accurately. There's a lot to do with what's going on in China, though.
Okay.
So I think China,
Lockdowns.
US geopolitical issues are playing some role. Brands like Cisco, HP, they all manufactured in China. Lockdowns, most definitely. The zero COVID policy in China is probably the single biggest thing that exacerbated that.
Okay. And the war in Ukraine, has that had any impact?
We haven't. I couldn't say
we haven't seen any of that.
Yeah, not because there's nothing directly attributed in manufacture to that. But there are base metal components that might translate through that. But I think it's too early. To see that yet.
What we have seen from Russia, because there's a lot of the American companies restricted any product into Russia, and that's become available for us to buy. So that's consistent supply, more consistent supply, put it that way.
What does it do for margins? I mean, when there is a tight supply, is it good for your profit margins, or do you prefer to have an abundant supply?
I prefer to have balanced supply.
Balanced supply.
Balance. We call it a balanced supply. So overall, the margins, now with the overstock situation, that's your finest line is, where's the balance of timing? It's all about a timing thing, converting stock into cash. So that's a very big thing right now, is that not giving the shop away, but we have to get the stock in profile. It's all about timing. Hold your breath. Let's see how long you can hold your breath. So it doesn't really impact on the margin.
So do you sit on the stock in your warehouse?
Yes, on the stock in the
and you just wait until...
You wait until the demand. So you slow down your purchases. So it's a timing thing. But it takes up to 6 to 9 months to slow down purchase. Few of the vendors, you've got 6 to 9 month orders in the pipeline. So that's how long it takes to filter down. So,
Look, over that time, you've had a devaluation in the rand as well. So the stock you've got, it's probably more about the rand than the supply. That's the
as the rand
biggest
weakens, your stock becomes more valuable.
Effectively.
Yeah, if you can get the same price for it.
But you can't because you've got competitors with stock as
and
well.
you're continually replenishing stock at higher exchange rates.
Yeah.
So the averaging makes your base effect higher. So it's not as simple as just it's oversupply. Therefore, you've got to cut the price. You don't really, because the rand has helped that. We've been lucky there. So.
Would you say stock management is the most important thing you guys do?
Working capital management, not only stock management.
Okay.
So it's a combination of working capital. So it's stock, debtors and creditors, and distribution specifically. Cash generation. Cash is king.
Right. Let's talk a little bit about the acquisition of Tarsus Technology Group. That was concluded last year, was it?
Last year, 1 July. Effective 1 July.
1 July effective, okay. How did that deal come about? You got it past the competition authorities fairly cleanly, I thought. Is it all bedded down now? And what has it brought to the Alviva stable?
Very fortuitous to be able to that to be offered to us. And that was retaining jobs in the market. That was the single biggest drive from the Competition Commission, is retaining jobs. Yes, we all know they went through tough times, but it's one of the best performing businesses we have now. So bedded things down. It's incorporated. The culture fit is spot on with the Alviva culture fit.
Right.
So it's been one of the easiest incorporations of any of our acquisitions in the last 6 years. So very pleased with the acquisition. 5 billion rand to the business, incorporated in, I think it was less than 2 months. It was great to see.
Amazing.
Also a very strong management team.
Yeah. Do you keep the Tarsus name? Do you keep it as a separate
Totally separate
brand within Alviva?
So the commitment we're giving to the staff and the market is for at least 5 years. We'll keep it separate, but there's no indication we're consolidating any of our businesses. The idea was to consolidate Axiz and Pinnacle going back 8 years ago, and that we stopped. So we run our business autonomously, and they compete. I don't mind healthy competition.
Why do you do that?
I like competition, keep them on their toes. That's what I prefer. So.
Is that the only reason?
No, it's focus. It's all about focus. So each business, if you consolidate everything, you're not going to have the focus that you're getting in each team. So the guys compete with each other. It's healthy competition, but it's focus. I believe 100% in focus.
But the companies address different customer segments.
I was about to ask, how do they differ from each other?
Maybe from the outside, and it's a common question we get, and in many cases we represent the same brands. So take Dell or HP or Lenovo, one of those. We all three represent those brands, but we focus and are good at separate reseller segments of the market, be it consumer retail or small business or corporate reseller, etc. And it's just worked like that. There are overlaps, obviously. But for the most part, that's why I say the group has got a nice spread, fortuitous spread of those brands.
Axiz specializes in enterprise retail.
Enterprise, right?
So enterprise, that's Axiz's core is enterprise and software. Then Pinnacle's core focus is they've got 8,000 active resellers. So they've got the breadth is there. And Tarsus is a mix of the two. So
if you were to combine them, you wouldn't get
1 + 1 is definitely not 2.
Definitely not.
You mentioned there's a bit of overlap. Do you, Pierre, encourage that overlap?
Yes, I do encourage it, as long as they don't undercut each other.
As long as it's healthy competition.
It's healthy. I don't mind healthy competition. Let the best man win. And it's on relationship, stockholding, and vendor relationship.
What happens if it becomes unhealthy?
It's a phone call.
What are you guys doing?
That's all it is. It's as easy as a phone call.
I would say, being on the receiving end of that phone call, we've always competed with these companies. You can add Mastex Group to that mix as well. These have been competing with each other for 30 years. Whether it's owned by the same shareholders or not, it's healthy competition. The market's found its feet. We've found our markets. We've found the price points. Different. It's not only about the competing brands. It's about the other brands, the software that some suppliers offer versus others. So it's a complete mix, and culture. I think culture is a big thing.
So each of these businesses has their own distinct culture.
Definitely distinct.
Okay. And management teams.
Own management team and own board meetings. So very little overlap.
Okay. So, Craig, I was keen to get a view from you on how the distribution industry has changed, if it has, over, say, the last 5 or 10 years. Is it different now to what it was 10 years ago?
Certainly 10 years ago. I think the distribution per se, 10 years ago we were talking about whether it would survive. There was the commentary in the market. All the commentators were, what is the role of the wholesaler? Will they make it, etc. I think now that debate is long gone, and there's debates of other sectors of the industry. I think so what's changed is much more pressure on distributors to find value and deliver value for the supply chain. Do more work, in other words. More demand creation, more marketing, in some cases more direct work that we never did before, services, for example.
With your clients?
Yes. Yeah, with our resellers and their customers. But building markets, I'd say, it's the creating demand has become a big job that suppliers are asking distributors to do. But look, the fundamentals are the same. Working capital management is, always will be fundamental. But software, that sector of the industry is changing a lot. Cloud making a huge impact in that. And those go-to-markets, and as those go-to-markets change,
Tarsus launched Tarsus On Demand, which is their cloud services business. How important is that delivery model to the distribution industry?
Well, Tarsus has got Tarsus On Demand. Axiz has got Axiz Cloud. Most of the big players have got a cloud platform or marketplace of some form. I think going forward, it's hugely important. Right now, it's still in the scale of things, a smallish contributor, 5 or 10%, depending on how you look at it. In future, we think that's going 20, 30% of our business will be cloud, delivery of cloud products in some form. Microsoft leading that charge.
Do you see yourself competing with the traditional systems integrators over time?
Yes, and in cloud, absolutely. I mean, because but we do already. And we wouldn't say we compete with that channel. We do indirectly. And as a vendor like Microsoft would appoint the system integrator as a direct cloud provider and Axiz as an indirect cloud provider. Understood. So we sell to another reseller, they sell direct to the customer, but we're all competing for the customer directly. But it's not typically different in some of the big hardware brands either. So I don't think cloud's special in that way. It's just, those are the routes to market I was referring to.
And you work much more closely then now with your resellers than you did historically, do you?
Yeah, I'd like to think so. But I think we've always had to work closely with resellers. That's nothing new.
Yes.
The way in which we work has had to change. So, for example, cloud would be delivered via a digital portal first. So the first engagement is digital. There's no people interaction, whereas in our corporate hardware space, that's still very much a people engagement.
Okay.
And we see that shifting more towards digital. As you would have, I think the banking industry, we always use that as a good example. Your relationship with your bank is primarily digital now. Call your banker when you need them. And that's how we see things moving.
See, your focus at Axiz is more enterprise focused, whereas, say, a Pinnacle would a Pinnacle work more closely with the retail channel, for example?
All three distributors work with retail.
Retail as well.
So each one's got a retail sector they focus on.
Okay.
So each one, so retail contribute between 50 and 20% of a specific distribution business.
Right.
And then so each business has got enterprise software, and then you've got your client computing. We refer to as client computing. Axiz is just the bigger player in the enterprise space, which is software and networking. And
the reason I'm asking is we know Amazon is coming early next year. February is the target date.
Waiting for that.
And I was just wondering what impact this is going to have on the market. E-commerce is growing rapidly. The big retailers are all focusing on rolling out e-commerce solutions. Massmart, Takealot's there, obviously. Amazon coming. What is this going to mean for distribution in South Africa, Craig?
Well, Amazon is a global direct distributor, wholesaler, direct e-tailer. Right. So Amazon is probably I would compare it to when Dell was direct back in the day. And a lot of people then said, it's over. Dell's model will prevail. There's no channel, there's no resellers, there's no distributors. I would expect in Amazon's case the same will happen. There will be Amazon Marketplace for distributors and resellers to play. So we don't think that it's all doom and gloom. It certainly will sharpen the focus on getting ready for a digital marketplace fight.
Right.
Distributors, resellers, we will have to have platforms and marketplaces that give you the same experience, that we can deliver product to you just as seamlessly as Amazon can.
Right. Always through your resellers?
I think so. We don't see a future where there's a direct distribution engagement. I think that's our reason for being.
Yeah.
We'd rather scale down or look for other options, other technology segments than change fundamentally how we work.
Yeah, and you'd then, if you were to do that, you'd risk annoying your reseller partners.
Of course. And it's not that simple either. It's contractual, contracts are usually delivered in a wholesale resale format.
Yes.
So a lot would have to change to enable that.
Yeah.
I think certainly some have tried. We wouldn't think that that's very successful now.
Yeah.
And it's a scale problem. There's how many 250,000 businesses that we're trying to sell to. You can't go it alone at that, Rather sell through 5,000 resellers to get to 250,000 customers.
Now, your acquisition of Datacentrics a few years ago, was that all part of the focus on becoming more of a services-focused business and having your distributors help your resellers more directly, or was Datacentrics very much a separate business unit that's not involved in the distribution side at all?
Datacentrics is completely separate.
Completely separate.
Majority of what they purchase direct from the vendor. So they don't really compete with the smaller resellers.
Okay.
Completely independent business.
Right.
So that was part of to be a well-diversified ICT group. So we've got system integrator, we've got solar, we've got Centrofin, which is financial, then we've got the cloud business, and then we've got distribution. Completely separate.
How do you decide where you play?
No, the strategy mapped out initially was we want to be in applications, we want to be in IP-based businesses, we want to be in system integrators and financial services and distribution. So initially it was only distribution, and we start diversifying in different clusters.
Okay.
And we target specific acquisitions.
Right. So you've got SolarF, Grid Cars. We had Winston Yudan on this very show a couple of weeks ago. Very interesting discussion. Maybe just take us through, Pierre, some of those IP businesses that you've got in your stable and how they're doing.
So the IP businesses are very disappointing, to say the least. But we believe in, so you need like a visionary companies or dream. That's in a Merlin. That's in your Grid Cars. Grid Cars, we might be 5 years ahead of the curve.
Yeah.
But at least we're now managing 100% of the external charging stations in the country. So yes, we're ahead of the curve. But we believe in the future is EV. We know that. That's why I invested in SolarF with renewable energy. So it's a very specific initiative. Ahead of the curve, now we can't get supply. Like we said in the supply and chipsets you can't get supply or approvals from government to your biggest challenge is get approval from government to install. Okay. That's from Eskom and municipalities to install the solar.
At homes?
How strange is that? At businesses? Now homes it's smaller. I'm talking about big business, shopping centres, shopping malls.
Right.
Give you an example. Mall of Africa, we did Mall of Africa, massive installation, one of the largest at the time, Southern Hemisphere rooftop PV. And everything installed, commissioned. Took government 2 years to prove them to flip the switch.
2 years?
2 years. Fully paid for 2 years. They weren't allowed to use the solar on the roof.
That's ridiculous.
Yeah, that's what it is. So
is that
you're hearing everywhere, yes, they want to drive renewable energy, this, but it's not filtering through. We're not getting the approvals.
Is that a NERSA process?
NERSA, yeah.
NERSA,
Eskom, and municipalities. Those are the three that we're struggling to get approvals in certain areas for. The size of installation. So we're sitting on a massive pipeline, orders in hand, we can't deliver. Majority of it due to approvals, waiting approvals.
Okay. And then there's the other business you mentioned, Merlin.
Merlin, it's a digital twin.
Right.
Send your digital twin to work. So it's effectively clone your thought processes and behaviors, and it's automation behind the scenes, the algorithms and stuff.
AI,
all AI.
And how's that business doing?
Still slow. So we signed up for a few big, so a few of the names, we've got FMB, we've got Axiz, we've got Sasol, we've got Discovery. So there are a few big names in there, but it's breaking even. It's not spitting money like we'd hoped it would.
Right.
So it's still early days, but there's a future. It's futuristic.
Yeah. And do you have any other businesses in the IP stable?
We've got Synergy ERP, where we've got very similar automation processes. They implemented the Sage at Axiz and at Pinnacle.
Okay.
So we own that business well, and that's mainly on Sage. So we decided, is it SAP, is it Oracle or Sage? Sage was the fastest growing outside of America, and we decided to go for the Sage as an application business, a Sage implementer. That's how we got to that business. But then the vendor changed its model from perpetual licensing to subscription, and your model from being profitable up front, now you have to wait 3, 4 years, 5 years for your money. So
right.
That changed last year.
So Pierre, there's you've been driving a lot of the consolidation that we've seen in the IT distribution market in South Africa through your acquisitions. Are you done? Are there other assets out there that you're interested in?
So as I mentioned earlier, Tarsus wasn't on the radar. It was just fortuitous for them to approach us, and that's how the deal happened.
Okay.
We weren't out there looking for distribution. we're looking for very specific IP-based businesses and application businesses. So Tarsus is an anomaly, skews the strategy for now to be important to have 50% EBITDA, more than 50% outside of distribution. Not that we're scared of distribution. Distribution will carry on growing. We just want to grow the balance of the business a lot faster.
Okay.
So the consolidation, we're not consolidating, we're still running independent businesses. That's what people see. They've got their own credit lines. There's not a centralized credit line from a vendor and then we dish it out.
Right.
Each district's got his own credit line, his own relationships with the vendors. So we're effectively just an investment company.
Okay. So if you're going to make acquisitions going forward, it's more likely to be on the IP side of the business.
IP and application.
Applications.
So if I'm saying we could get a nice consulting business for Oracle or for SAP, we'll consider that. Yeah.
Okay. Okay. So I want to, before we wrap today, talk about this acquisition that is potentially in the works. You announced, when was the initial announcement? A couple of months ago now.
Yes, that was in June.
June already. Okay, so there must have been some progress since then. I understand you can't talk about what hasn't been disclosed to the market yet, but the announcement was that a black-led consortium is going to buy out Alviva Holdings for 3 billion rand in cash, or 25 rand a share. Proposals have been put on the table. Investors include TAM or THAM Investments and DY Investments 3. Who are these guys, first of all?
So the two main guys there, the one is Fani Mutlangu. So effectively, he started with owning the software, e-native software. He sold it to government, and that's where he initially made some. The government still owes him a lot of money for that, but that's a different discussion. And the other one's Puven Ramasamy. He was at APSA for many years. He's an industrialist as well. And then he owns mines and various other initiatives. So he's got a very well diversified. These companies called Amava and very well diversified, chrome mining and stuff like that. And they just met with us going back 4.5, 5 years ago. Okay. That's when the process started, about 5 years ago, when they started engaging to do a possible buyout of with the management.
Yes, that's been coming for a very long time.
It's been coming for a long time.
Are they existing shareholders in Alviva?
They're the largest shareholders, yeah.
Okay. Are they your BEE partners?
Yes.
Okay, understood. Okay. So this conversation about the entire group, has that been in discussion for the last 5 years?
Yes.
Okay. Why did it get serious now? What happened this year that it decided to?
So the funding wasn't available. So I mean, through COVID was a big dead stop for all of us, where all the funding just dried up. People weren't prepared to what's going to happen in the world. And funding dried up. A year after COVID, yes, the funding started becoming available, and opportunities there now.
Understood. So you have appointed, I presume, an independent board and an independent expert to, I think the terminology they use is opine on the proposal. Where are we in that stage, in that process?
So most of the fair and reasonable is done. The independent board's appointed. They're busy with all the various things they need to do to get it through. So there has been progress. Now it's about pricing.
Right.
So the next step will be we're allowed to approach 5 of the top shareholders and get irrevocals from them, whatever price we can go to market on, and get them to agree on a price.
Okay.
And then we can go to market. So it's still a process.
Right.
Still weeks away, but months away, but it's slow. It's frustrating, but it is what it is.
Right. So the independent board has to opine on the fairness of the offer price, do they? Have they done that yet?
Yes, they've done it.
They've done that. Is that public knowledge?
No, it's not public knowledge.
So they still
that's what you need to sit with the shareholders and see if they're comfortable with it. So
I see.
If you get the 5 top shareholders, irrevocals and like, then you can go to market.
Okay.
Else you might be wasting your time.
After your stunning recent results, I imagine there may be some conversations about whether...
everybody's just saying completely underpriced. You need to pay more. And I explained to them last week in a session, I said, it's quite important that 18 months ago, the share price plummeted to 5 rand.
Yeah.
Not one shareholder was prepared to buy 1 share at 5 rand. That's 18 months ago.
I remember.
Then we started the discussion with the EB. It really started at 13 rand. It came to the board at 15 rand. So at 15 rand, the board had an offer. Initial offer was 23 rand. The board rejected it. It went away, came back at 25 rand. The board said, okay, that's more reasonable for now. That's at 15. That's a 66% premium. And that was after we released stunning half-year results. So the price had normalized at 15. Then from 15, something leaked into the market. It went to 19. And the offer out was 25. So everyone was saying it's under. I said, guys, no one. We've had major companies look at us in the last 4 years.
Right.
They do full-on DDs for 9 to 10 weeks. And the feedback generally had come back is your margin, it's marginal. It is. It's distribution. So if there's a blip in your margin, it's going to impact your profitability in a meaningful way. Your variability of your working capital is a concern. So you might need a lot more. You might buy the business, and then you might need another 1 billion rands of the working capital. So you need to stand good for that as well. So it's not only 3 billion, If you're looking at it, it's like 4 billion you're looking at, because you need to put working capital into the business. And then just the overall, your business is very complicated. People think distribution's easy. It's more complicated than people think. You've got so many different balls in the air, and you just need to try and get them aligned.
Yeah.
And then after 9 weeks of DD, they come back and, and these are large companies that have looked at us. So I said, guys, please, if any of you are prepared, please. They said, have you received any other phone calls? No, we haven't. We don't have any other offers on the table. People just don't like distribution.
Yeah.
More
It's a tough
South
business.
Africa.
It's a tough old business.
It's a tough, I'm telling you.
Yeah.
And it goes back to 2000 with the demise of Soltec, unfortunately for us.
Yes.
And it's still back of people's minds, and they're scared of distribution. So we don't mind it.
So management is also involved in this
Yes.
in this transaction. In what way? How will?
So management will have a stake in the business.
Okay.
And then your stake is only worth when you repay the debt, and that'll be in year 6 or year 7. So
Right.
management's tied in for many years.
Right. Right. Management being the leaders
All
of the
all
businesses.
the minimum is all the CEOs and all the CFOs
Okay.
in all the large subsidiaries.
Now, if this deal goes ahead, which it's sounding like it's going to, the business is going to be delisted. Does that have any advantages to you or any disadvantages?
We'll carry on running the business as a corporate entity, very corporatized, like I said. We have formal board meetings every single month with every single subsidiary,
Right.
and that won't change.
Governance will stay the
Governance
same.
will stay.
Was there any advantages you got from being a listed entity?
Nothing.
Nothing.
No.
Right. So
Not that I could see.
it makes no sense for you to be listed.
No sense whatsoever. We've never gone out on a rights issue to raise money.
Right.
It's just the market doesn't see value in your business.
Right.
And the worst of it is it's in small caps.
Yeah.
Worldwide, small caps is not the flavor of the month, so people don't invest in small caps. And then the benchmark used to be, if you're over 5 billion, the international guys will start 5 billion market cap. International guys really start looking at you. Now that's moved to 10 billion. So if you're not at 10 billion market cap, you don't get the international pension funds and investors investing in the business. So that's why if you look at the activity level on data tech, they're there at the 10 billion.
Yeah.
There's a lot of activity, a lot of interest in there. It's a very similar business.
Yes.
That 10 billion market cap.
Market cap makes the difference.
But lots of the global distributors have delisted off the NASDAQ even. So even at global scale
no value.
level, the biggest in the world, Ingram Micro, these guys. Some of them are planning to list again, but they either go private equity or delist entirely.
This is obviously just more bad news for the JSE, which is seeing continuous delistings. The size of the bourse has shrunk dramatically in recent years. Is there anything the JSE, in your view, should be doing better to retain a company like Alviva on its
We've had
listings?
I said to them, I had a few sessions with them of late. I said, if we remain listed, it's not to say it's going to happen. Remember, it's not a foregone conclusion. So if we remain listed, we'll gladly engage to have very specific days with all the investors.
Yeah.
It's a very specific small cap investor days. Come and tell the investors what you are.
Right.
So I said, gladly, but why now? Why didn't you do that 2-3 years ago? But that's fine. If we remain listed, we'll gladly engage with them. So there are various initiatives that they're busy with, which fits in perfectly going forward. It'll be fine.
Yeah. Pierre is Group CEO of Alviva Holdings, and Craig Brusden is CEO of Axiz. Gentlemen, thank you so much for making the time to talk to Tech Central.
Appreciate it.
Thank
Thanks
you,
for your time,
Duncan.
Duncan.
Thank you.
Thank you.
Thank you.